as a result of COVID, we had a lot of fiscal stimulus added to that monetary stimulus, along with the rebound of the consumers coming out of COVID, and that created real inflationary concerns and real inflation. And obviously, as a result of that, the Fed has reversed course, raised interest rates fairly aggressively, and had reasonable success at stemming inflation. We think the likely path forward is more stability in interest rates and probably some decline in interest rates as the Fed tries to get ahead of economic weakness. But we're back in, I think, a period that's more normalcy than anything else. People talk about this abnormal high rate environment. Rates aren't high, rates were extraordinarily low back in 2019. The abnormality was a zero rate environment. So we believe we're back at a period of stability. There's going to be a continued push and pull between economic growth, interest rates, and inflation. But we believe this more normal period is better for our investing strategy. Obviously, what we have to think about in a period like this is what are the degrees of outcomes on the high end and low end of those different variables, and how do we generate growth in our portfolio companies while mitigating downside risk in this environment. In our private equity business, how we managed risk during that period of abnormality with rates at unsustainably low levels, what that led to was exceptionally high valuation multiples in 2019, 2021. In that period, we became net sellers. We took a point of view that those valuation multiples would not continue and they'd come down over time. We didn't predict COVID, but we did predict that valuation multiples were exceptionally high. As multiples have come down, as interest rates have come up, we've rotated to a more balanced posture between buying and selling. And we believe that's the right approach.